All right. Thank you everyone for joining. I see a lot of people joined and some are still joining. I think we are 5 past 10, so I'll just get started. So today, welcome everyone to yet another enriching session of the IIT Guwahati Alumni Association webinar series. This series serves as a dynamic platform for all of the IIT community, IITG community. And that includes alumni, students, faculty, staff, and anyone else who is associated with the larger IITG alumni community as such. So this webinar series is to engage with thought leaders, innovators, experts across various fields. And it is tailored for those who are eager to expand their knowledge and explore emerging trends and gain insights into the diverse professional landscapes. Through these interactive sessions, we aim to foster a culture of continuous learning, networking, and inspiring our IITG community in their personal and professional endeavors. Well, today we are thrilled to have Ashish Kakran, a distinguished IITG alumnus and a VC investor at Thom West Ventures. And he's also recognized for his contributions to the fields of cloud, AI, and cybersecurity. Ashish has earned accolades as a rising star in the venture capital realm, and reflecting his profound impact on the early stage startups. Our discussion today is centered around decoding the venture capital funding, a tech founder's roadmap to success. This promises to be a guide for the tech founders looking to navigate the complexities of venture capital funding. Today, Ashish will be shedding light on navigating the venture capital landscape, the ideal timing for raising funds, and the strategic development of tech products. So before we dive into this session, I just want the audience to know that we encourage an interactive participation. So please feel free to submit your questions in the Q&A section of the Zoom. And if someone wants to talk and ask a question, please raise your hand using the Zoom feature, and I will unmute you to talk and ask your question. So having said that, without much further ado, let's welcome Ashish to share his invaluable insights today with us. Welcome, Ashish.
Yeah, thanks so much, Vikash. It's a real pleasure to be here, to be with IIT Guwahati alums, students, and the broader community focused on technology. And this is Saturday morning. You could be anywhere, going on a hike, being with family, or even sleeping, but you took time. So it means a lot. So thank you. So typically, the way I like doing it is, keep the session very interactive. So if you have any questions at any point of time, please feel free to jump in. I also have put together a brief presentation to talk about Silicon Valley, what makes it tick, founders, how should they think about fundraising, what is the VC investor thinking when he or she is talking to you, what is the ideal deck. So we'll cover all of that. So what I'll do is I'll spend 30, 40 minutes on the deck, keep some time for Q&A in the end, but as you have questions, please feel free to jump in. So I'll go ahead and share my screen. All right, so I'll start with the simple questions. How many here actually want to start a company someday? Just send a note in the chat window. I'll see that. Great. So I see a lot of hands. So perfect. I mean, this is the ideal discussion to have on a Saturday morning. So let's continue. This is going to be the agenda. I'll start with my story. My experiences as a founding engineer, as a sales engineer, product manager. What did I learn? What makes Silicon Valley tick? And then the last section would be how to reach VCs, which is something that maybe first-time founders struggle with sometimes. So about me, I'm an investor at Thom West Ventures. Vikash briefly mentioned the fund is based in Silicon Valley in Toronto. We have $750 million under management. A few months ago, we announced our most recent fund, which is $250 million. So stage agnostic in nature. We do anything from seed through Series C. Check size for us can be up to $20, $25 million. Happy to lead or co-lead a round or participate. And my focus here is, along with my partner Umesh, is more cloud infrastructure, AI infrastructure, and cybersecurity. A lot of constant change is happening in these spaces, and we love working with technical founders. So if any of you want to start a company someday in those verticals, I'll be very happy to help. And I'm a IITG alum, fond memories from my time on campus. It has had profound impact on myself, both professionally and personally. I met my wife there and learned quite a lot of things which continue to help me to this day. But briefly, here are some of the portfolio companies that I've invested in, which you might find to be interesting. One is Cohere. Right now, we are living in a very exciting times. Technology innovation that was expected maybe in 10, 15 years is here and now, which is the field of generative AI. There is this paper, Attention is All You Need, that was written in 2017, which basically kickstarted this entire innovation. And now machines can actually pass Turing tests. They can behave like a real human. And the founder of Cohere is one of the co-authors of that paper. So we are excited to partner with that company. Harness is in DevOps, CI/CD automation. It's basically in software acceleration. In the past, you would have to build those building blocks yourself. But now using a modular approach, you can quickly, ship features to production. Where it took 9 months in the past, now you're doing multiple feature releases a day. Isovalent is open source company. We recently sold it to Cisco, so very excited about that. But the most exciting thing here is there is a stealth company that I invested in, and it is founded by IIT Guwahati founder. So I can't wait to talk about it this summer. But that's why very excited about IITG and all things that you guys will be building in the future. So when I look at my career, there are three things, a typical transition from a purely technical person to somebody who focuses on investing now. So a long time ago, I was an engineer, and my focus at that time was building eJones, which is basically, it was a prediction market-based startup. We had large customers like Federal Reserve Bank of San Francisco. We had conversations with Warner Brother Media in Los Angeles, pretty large customers. As an engineer, I was very excited about the technology I was building. And my focus was technology out. Hey, if I build something really exciting, really cool, the customers will obviously come. Product is working, technology is solid. But over time, that company did not work out. One, it was a question of timing because 2009, 2000 time, there was financial crisis, similar to what happened recently. But two, also product market fit is so important in in building a successful company. You can have the best technology, you can have the best team, but if you don't get the product market fit, then nobody can help you. And how do you do that? You basically switch your perspective from technology out to customer in. So really focus on the customer. What pain points are they trying to solve? And work backwards from that to build your core technology. So this insight then helped me as I transition into a sales engineer role. Now, sales engineering, I don't know how many of you are familiar with it, but if you want to move from a pure engineer to a product manager, there are multiple different paths. You could take the MBA path, you could keep growing into the company, but I think sales engineer is also very, very interesting. What you do basically is you work with your sales team and you work directly with the customers. So you're doing a lot of product demonstrations. You own the POC process. The POC is basically when your customer actually uses the product and gets value out of it. And at the end of it, the outcome is, did they buy or not? But one thing that I learned there was, when you talk to customers about the cool technology and products that you built, we have the tendency to gravitate towards shiny objects, right? Any new technology language comes along, we want to learn it and master it as technical people. So we do a lot of show and tell, which is like, hey, take a look at this product. These are all the bells and whistles. This is how it works. But on the other side, customer is not there to listen to your pitch. So active learning can really help you when you're in those customer conversations. So do a lot of Q&A in the beginning. Hey, why are you here? What's keeping you awake at night? What problem are you trying to solve? What tools are you using? What's the gap? And then based on that, you will have some insight into the core problem and then use that to craft a story. And that was very helpful as I was closing deals ranging from 5K ARR to $1 million in a year. And with that, I gained enough insight into the customer behavior, the customer persona, that it helped me move to a product management role. And as a PM, now it was a very interesting role. By the way, product management is amazing. So here, think of it as a CEO of a product. So whatever piece that you own, you are making the decision, right? You're talking to the customer, you're talking to your marketing team, sales team, customer success, your CEO, your C-level execs. In the room, imagine everybody is there, but the customer is not there. So you have to be the voice of the customer. And the way you develop that is you have to step into the customer's shoes. So there is a very interesting framework called jobs to be done, which basically says that when customers use different products, they are hiring or fighting those products to solve something. They are not interested in just learning about how cool the technology or the product is. So by applying that jobs to be done framework, you can have intimate understanding of customer behavior and expectations. And when you tap into that, it really helps you build a winning product and winning product roadmap for the future. So I thought I would share briefly my past experience because this has helped me in multiple roles within technology companies. And second, now when I talk to potential founders, it's very helpful because I've been in their shoes. So that leads to a lot of empathy. I know how it is when things don't work, and I've learned how it is when things actually work beautifully. And at least I can help founders avoid the initial mistakes that I see sometimes people make, which I made, by the way, which I've shared openly with everyone here. Um, Now let's switch gears a little bit, and I'll maybe pause after this slide, maybe one more to take any questions. Brief history of venture capital. Silicon Valley is amazing, and this guy right here, I don't know how many of you are familiar with him, but his name is George Dorio, professor. After World War II, he started a company called American Research and Development, ARD, and he invested $70,000 in a company, in a computer company, which an image is right here, and that turned into $355 million. This was first major VC success, and it proved to the world that venture is possible, and you don't have to be a high net worth individual. College endowment funds, pension funds, they can be a part of this new asset class. And by taking high risk, there could be high reward that fundamentally changes the world. And many of his former students and employees ended up forming some of these VC funds that continue to this day. So what makes Silicon Valley tick is this cycle of innovation that keeps going. Every new fundamental breakthrough in technology, you can trace its root back here. On the left, I have an image of Arthur Rock, who was a student of Professor Dorio, which we saw in the previous slide. He helped fund a company called Fairchild Semiconductors. He was basically instrumental in convincing the 8 people on the right that they should start a company. They were employees of a company called Shockley Semiconductors, which, by the way, started the whole Silicon Valley. That was the first major company to be founded here. And these are the 8 people who started Fairchild Semiconductors. So on the left, there is capital. On the right, there is innovators, visionary founders. And when those two come together, magic happens. A lot of these people ended up starting other companies, companies like Intel. There's Gordon Moore right here, who gave us the Moore's Law, which basically said every 2 years, the performance will double and the cost will halve. And that kind of has continued to be true to this day. There's also Kleiner Perkins, which is another fund that was started by one of the gentlemen here. So this was in 1970s, late 60s. And then now we hear about PayPal Mafia, right? A lot of those people ended up starting new companies. Now we hear about Google DeepMind or any new company that goes IPO. A lot of those founders have experience building and scaling the companies from when it was just a piece of code to when you have millions of dollars in revenue. And then they have the innovative mindset and understanding of the customer to build something that they can sell. And this cycle keeps on going. And right now we are in the massive new hyper cycle, which is just starting, which is around generative AI, which is going to change the world in the next 10, 15 years or longer. Before I move forward, I'm going to take a pause here. If there's any question, feel free to jump in because I want to make sure this is interactive. And if not, we'll keep going.
So Ashish, there is some questions flow coming up in the Q&A section. So one of the question is, what strategies can founders use to ensure they are not perceived as too technical or too business focused in their pitches? Maybe you're covering it later, but this is a question that came in.
Yeah, I think this is a excellent question right before my next slide. uh, so thanks for helping set this up. But basically, now let's dive into the persona of an engineer. I've been there, build code, code all day. At the end of the day or end of the week, you have something that you can show and be proud of. But that also means when I go to a networking event or a happy hour, oftentimes I found myself sitting in a corner on a high table, grabbing a drink by myself, talking to maybe a friend or two and leaving. Whereas this is a room full of 100 people with so much opportunity. There would be founders, there would be product folks, there would be senior engineers, designers. And by talking to any of those, there was an opportunity to learn and maybe like something happens that's like meaningful for the future. So from there are a couple of things that really helped me. So I would encourage everyone, if you are like that person, like I was in the past, these two things would be very helpful. First, on the top right is the warmth and competence. So a lot of times when what will happen is you will meet people on the elevator, you will randomly run into somebody at a coffee shop, and it would be like a 30-second, 1 minute interaction. But that is a massive opportunity for you. And how you change those chance interactions into opportunities can have a meaningful impact into your future. So two things that I learned: whenever you meet somebody, make sure that they get a sense of warmth from you. So when you meet them, be genuinely excited about meeting them. Ask them meaningful questions about themselves, and show excitement that, hey, you're genuinely interested in their story and not just talking about yourself. And the second on the x-axis is competence, right? You have to be on the top right of both warmth and competence. What I've found is the most amazing leaders and founders are high on both. If you're low on warmth and high on competence, you'll be appearing to be cold kind of person that people may or may not want to work closely with. If you're high, sorry, envy, cold, and people have some sort of resentment. If you are high on warmth and low on competence, that basically leads to a feeling of pity where the other person may or may not want to help you or be around you. But when you are in this quadrant, people want to meet you again. So now you have changed that 30-second interaction into a follow-up meeting. That could be a coffee meeting, a Zoom call, or you go meet them in their office. And then that's the beginning of a longer conversation where you are both building trust and a long-term relationship. So focus on this whenever you meet somebody new. And basically being warm is so easy. Like there's nothing to lose. Why be arrogant when you can just be a nice, warm person to hang out with, right? And you can practice it. And over time, you will be genuine about it as well. The second one is get out of your comfort zone. The true growth happens when you're out of it. Networking can be a very positive experience. I gave you an example of what I used to do when I went to networking events, right? Because it appeared very salesy, very slimy, very transactional, right? You go talk to somebody for 5 minutes and then you're like, okay, bye. There is not much to do here. We won't be collaborating together. But now imagine if you're in a room full of 50, 100 people, and you meet somebody who is basically who sells seeds, right? Now you are in technology, maybe you don't know anything about seeds, you don't care about seeds, but now you know one person, and then you randomly talk to somebody else who basically sells seeds online. Well, guess what? Now you can connect them, right? And you have created impact, and they don't know each other, but you have done that. You do this enough, and you have created enough opportunities for yourself. So when you go to these kind of events, try to get out of your comfort zone. Try to talk to at least 4 or 5 people. If not, like make sure you talk to 2 new people and then do follow-up calls with them and try to build the relationship. So those are the two things I would share with everybody, especially for students on campus. If I could get a sense of how many students are joining this right now, that would be very, very helpful. If you could raise your hand or type in the chat window. Okay, at least a few. So This is important because when you are a student on campus, your worldview is very different, right? You are getting compared with your classmates. The opportunities are limited that you really want to chase, but the size of applicants is very, very big. So you may think like, hey, first job out of school will determine the future. If not, everything is lost, right? Logos matter, GPA matters. These are true to some extent. But what I've seen having worked with a lot of amazing founders here in the Valley is the real world looks completely different. Your network will determine the future. And your network is something that you've developed over time, and you have to be very intentional about it. It won't happen by itself. You put in effort, you meet people, you give before you ask. That's really, really basic. 10,000 hours win over logos any day, uh, which we have seen to be true. Like pick up any founder here who is building in cloud infra, data infra, cybersecurity. The logos don't matter. What matters is the product and what pain point you're solving, how many customers are there, how big is that market, and is your technology differentiated? And the final piece is after the first job, nobody cares. So hope this helps the people who are still on campus, because I'm sure you're going through these thoughts right now as you prepare to enter the real world. Um, and two things I would definitely like to highlight here. At some point in your career, who you know may lead to better outcomes than what you know. Because in venture, some people say capital is a commodity. So as a VC, the value that you bring to the table will determine if a founder wants to work with you or not. In a similar way, I won't say knowledge is a commodity. It's very important to be successful in life, but there's so many people with similar level of knowledge or more knowledge than most of us have. That's just the nature of how the world is structured. In that world, if there's some level of progress that you can make on your own, like working hard, learning more. But if you want to go and break that glass ceiling, I think somebody very senior has to take a bet on you, because they will have to coach you, mentor you. Their reputation is on the line. They cannot make a bad hire. It reflects bad on them in the future. So give them a reason to take that bet on you. And I can tell you that will have such a massive impact on you. It has had on me. There's so many people in my life who have taken a chance on me when I was an intern, or when I was moving into product, or when I moved into venture. Somebody had to take a chance on me. And then you work very, very hard to make sure that their decision was correct. And the way you do it is you give before you ask. So even here, like if you're reaching out to folks on LinkedIn after this, try to be helpful. See what are the different ways. If there's somebody junior, you can look at their profile and tell them, hey, this is a job or an opportunity that's good for you. The other thing is take negotiation classes. I cannot emphasize this enough, the impact it has on anybody's life. So typically when we are in these situations, say you have a job offer, right? It's pretty good. It's better than what you have imagined for yourself. I think you should still negotiate. It always leads to better outcomes, because it also signals to the other side that they made the right offer or not. That you are negotiating. That means they made the right call, and now they need to increase the comp to whatever you're expecting. But comp is not the only thing you can improve when you're negotiating. Negotiation is part of daily life. What project you get, what assignment you get, when you talk to your boss for go with like an offer for them. Like, hey, these are the three different options. I think maybe this is good, but what do you think? I'm giving a simple example, but what you have done now is you have taken the decision from the boss's hand, and by giving them the three options, you're letting them make a decision, but you have designed those three options that create great opportunity for you. Um, Two specific examples. I've helped friends with negotiation. One, a school student a school teacher who increased the comp 1.5x after negotiation. And second one who almost got $1 million in salary. So I would highly recommend take negotiation classes if you can, go online, read those resources. It will have meaningful impact on your life. So let's switch gears now. Now that we have talked a little bit about journeys and skills and how do you develop those skills, let's say you are now ready to raise VC money. You want to start a company. Should you even raise venture capital for your startup? Or, it's better to bootstrap it, The expenses are low. Maybe I can build the company with my friend. Two of us are sufficient. We raised a small round, 200, 300K with friends and family, and build the company. Because VC money will come with a lot of expectations too. You're kind of on a treadmill after that. You raise seed, then you have that. The way it works is, let's say you raise seed. Seed capital would be anywhere from $3 to $5 million. Well, today seed is fundamentally different. Seed for an AI company could be 50, $60 million. So don't be completely surprised. But those financings are rare. You raise a 3 to 5 million seed, the technology risk is very high. The investor is basically making a bet on the team. It's basically team for investors. That's what they're thinking at the back of their mind when they're talking to you. Seed is purely focused on the team, technology, and is this going to be a big market in the future? Like if it's a big market already, maybe it's too late for seed. That's how some people would think. Then that gives you a runway of, let's say, 18 to 24 months, which is pretty typical. Within that, you have to hit your next goal to get ready for Series A, which is going to be another financing where technology risk is a little bit reduced, but now you have to prove that you have product market fit. Then that gives you another 18, 20-month runway. Then you raise your Series B, at which point you have proved that you have hit product market fit, which means founders don't have to go to every single sales meeting. A salesperson that you've hired can actually go and close on your behalf. You don't need to be part of that. And now it's basically growth time. So then it's a question of how much can you grow? If you have a single product, how do you upsell, cross-sell? What kind of adjacent products do you need to build? Ultimately, you build it all the way, to an IPO and an exit. That's outside of anybody's control. But what you should think about is you're kind of on a treadmill where you're setting expectations and you have to hit those goals. And if you don't hit those goals, there is some penalty. But if you do raise seed VC money even after that, there's a lot of benefit. If you're building a company in chips business, and if some founder has previously run that company as a CEO, they had a lot of experience and expertise at the board level, which can have a meaningful impact on the trajectory of a company. Whereas some board members can actually add negative value too if they don't have the right experience in your particular domain. Once you raise VC capital, we help a lot of our portfolio companies with design partners, customers. Once you make an announcement in places like TechCrunch, a lot of exceptionally talented people want to work with you. So it helps with generating that pool of good candidate as well. There was this Silicon Valley Bank collapse situation last year where we were working very hard to make sure that capital is available for our portfolio companies to meet their payroll need. So there is a lot of benefits. And one thing I did not mention here is if your competitor raises a large round and out executes you, you don't want to be in that situation. So there are a lot of benefits. I'll take a pause here. Vikash, looks like there's a question.
Yeah. I mean, this is great information. One question that is coming up is, are we saying that if we take the VC capital, if the founder chooses to take the VC capital, then that all comes with the advantages you're talking on the right-hand side of the slide. So once, so I think maybe you can explain a bit further by saying that. Once a founder chooses, these are all the things you can tap into as the networking effects of getting into the VC circle.
Yeah, absolutely. Basically, that's what I was suggesting. These are all the benefits. To give you specific examples, when I invest in a company, I run a few different networks here. One is a network of CIOs and CISOs. It has about 100 plus CXOs. To get a meeting with any of those for a first-time founder, it will take 3 to 4 months because you have to work your way up the organization. But when we, invest in a company, we make these key decision makers available to the founders. Then I run a couple different networks of investors. So if my portfolio companies are raising, I'll see, who are the investors in my network who focus on that particular area, and then I'll make that introduction. And warm introductions are very helpful in this business, which I'll talk about in another slide. So yeah, the takeaway is it's going to be a lot of work, but it's totally worth it. if that's what you choose to do for yourself. It's individual choice. If you want to start or don't start, you can't go wrong with that decision. But if you do want to start a company and raise venture capital, there's just so much benefit. Now, you also have to spend time with the right investor too. Like some investors, like I said, can add negative value at the board level. Some investors may just write you a check and then you can never reach them. They are at a golf course playing golf. So you have to put that work in to build relationship with them, trust with them, and get a sense of how they operate. And you can get a lot of that details talking to their prior founders who they have invested in, do blind references, and I'll talk about some of that later in the deck as well.
Ashish, there is one more question here. Um, how to set the valuation of an AI company at seed round level?
Yep. I will cover valuation in depth as well. So let's continue. And seed AI is a very interesting question, right? I'm just debating. Let me take that in just a few slides, just in
Sure,
the
sure.
interest of
I'll
time,
keep
and so
it
that
on.
yeah,
Yep.
we'll come back to it.
I'll keep it a parking lot. There are many questions coming up, so let me see if there are anything relevant you want to answer right now. One question is angel investment the same as seed? If not, how does it differ?
Yeah, so good question. Angel investment is basically you're raising capital from, angels, right? These are people who are very senior in some company. They have now retired, or they're so busy, they don't have time to, invest in companies, write larger checks, but they want to help companies or founders that have, sold their companies and now they are chilling on the beach. So what you do is you bring some of these angels on your cap table. They typically write a 25 to 50K check because it's individual, it's their personal money. You use that to basically prove to yourself that the idea that you have is worth building, right? You talk to like 30, 40 potential customers, you get that feedback, you talk to potential co-founders as well in your network. And this could be a 3 to 6 month process, but you still need to survive during that time. So, angel round could be, you know, 200K, 500K, very, very small round that helps you get started. And once you're convinced that this is the right idea that you want to pursue, then you can raise seed capital. The way it helps is these angels will then activate their VC network as well and make introductions. And those warm introductions will be very helpful. And by the time you talk to some of these early investors, you may have some data. Now, I'm not saying everybody has to take that path. A lot of founders, just quit whatever they're doing. They see an opportunity in a large place like Meta or LinkedIn, something that getting done at scale, and smaller companies don't have access to that. Enterprises don't have access to that technology. And they're like, hey, this needs to be separated out and we need to create a new company to solve this problem. And then they reach directly to the investors and raise the capital. So there are multiple different ways. I can't generalize it by saying this is right and this is wrong. This is not possible. There's just shades of gray all along. But do what is right for you. If you can raise angel money early, and these are people you believe will help you build a successful company and open doors for you, take that money. I think that will be very helpful.
I think there is one more relevant question for the slide, Ashish. What is the right stage to raise the VC money? What are the benefits of bootstrapping and using our own savings loan to start it initially?
Yeah. I think if I were to start a company hypothetically tomorrow, I would try to raise venture capital. There's just so much benefit to it. There's benefit of scale, there's benefit of experience, expertise. If you bootstrap, the risk is you will keep spending money and cycle, and from point A to point B, when you may not know what is the right time then to raise venture capital, because then you will start thinking about dilution and care about things that potentially you should not at early stages of the company. So there are pros and cons. I've seen bootstrap companies be successful. There's one founder that built a company, scaled it to about 25 million ARR without raising any VC money. That company was acquired, and this founder ended up being a very successful persona in the long term. But that is rare. Now, Raising VC money also is not guaranteed success. Like there's a high likelihood of failure. As a matter of fact, in this slide, there's a very high 49% is conservative. There's a very high chance that on any investment, VCs lose all the money. So there is risk on both sides. There is pros and cons of both sides. But I can tell you, if I were to start something, I would potentially raise VC capital, just because why go through that additional stress of diving into your own savings and putting your house on the line and all that you've built for yourself, when there are investors who believe in that vision, who have thesis on that specific area, who can actually help you build great companies, who can actually help you connect with a co-founder. Like maybe you're a very technical person who don't know how to sell to customers. And maybe there is some GTM founder somewhere who is now getting bored, who wants to start another company. Investors have those networks and they can facilitate those introductions, which otherwise are very random, and a serendipity could happen, but also low likelihood outside of that.
Thanks, Ashish.
Yeah, so
Would you one more question, or would you like to go forward, Ashish?
I think it's 10:40. Maybe we continue and then keep this. I have time even after this to take more questions, just in the interest of time. So the way
Awesome.
VC funds are structured, it's a typical 220 structure. Now every fund is separate, based on their prior performance, long existence. This fee may change, or this gain, which is also known as carry, that may change. But the way it works is there's this persona called limited partners, which is an LP. These are college endowment funds, pension funds. They allocate, let's say, 2 to 5% of their large corpus of money, and they allocate it to venture capital because they know it's high risk, but it could be high reward. Traditionally, venture capital, I was looking at some study, it actually beat S&P 500 in annual returns. So these large LPs want to tap into that, and they want to be supportive of innovation and innovative founders. What they do is they'll put some money into a fund, which is then managed by general partners. These are GPs at any fund. They take a 2% annual fee on the fund, and then build a portfolio of companies. Now, this is a simple 15 portfolio, 15 company portfolio. It could be more or less depending on how much you allocate to each company. The understanding is, majority of the company will return almost nothing to 1x low, but some have to hit it out of the park. You need a few companies in your portfolio that become the Ubers or LinkedIn's or OpenAI's of the future, because that will fundamentally change the trajectory of the fund. So imagine, let's say simple math, it's $100 million fund with a 10-year cycle. At the end of 10 years, you basically have to return money to the capital, to your LPs. $100 million fund, fee is 2%. So basically about 20% of 20 million of that is spent in fee, travel, employees, and whatnot, all the stuff, all the work that investors do. With that 80 million, you have to generate at least 100 million so that you can return 100 million back to the LPs. And after that, whatever upside is there, you return 80% of that to the LPs, and then 20% it goes to the general partners. So that's the typical fundamental structure of a venture capital fund. I know some people just may not be familiar with how this is structured, but I wanted to make sure that everybody has some understanding on what's the math behind it. Venture returns follow power law, which means there's going to be one or two companies that will make or break the fund. Others will have, not a meaningful impact. As a matter of fact, I was reading some study recently, 6% of companies generate 90% of all returns in venture capital. So why is this relevant for you as a founder? If you're starting a company, having a conversation with investors, at the back of their mind, they're asking this question, can this company return the fund, right? Which is pretty big. If it's $100 million on the exit, you want to make 100 million so that you can return it directly to the LPs. And the risk is very high. So how do you get high return when there is low risk? When there is not too much more data available. So a lot of it is going to be bet on the team. And we tell everyone it's like team, especially when it's seed, Series A. Because a great founder, what they'll do is they'll make a bet on an area, they'll solve a problem. And if it doesn't work, they'll pivot. And most companies go through that pivot. And best founders successfully execute that. That's how companies like Slack were created, where the founder of Slack was basically building a gaming company. He threw in he gave up and he was about to return money to the investors. They said, hey, keep it, do figure something else out. And he saw that in his gaming product, there was a chat window that people were using. And that chat ultimately became Slack. So, anyways, the question for investors is then, can this team execute? So, as you think about starting a company, as you think about your potential co-founders, maybe it's very tempting to work with friends, right? Because you have deep history together. But don't compromise on the competence and make sure that you complement each other's skill set. That would be very critical. So on the earlier side, team and core differentiated technology will be very, very critical. So hope this is helpful. Um, Quick question for everyone. Just write in the chat, when should you write the first line of code? You're a first-time founder starting something. Is it after raising venture capital? Or is it after talking to a few friends in the industry? I am not seeing any. Okay, four. As expected. So basically, this is another fundamental mistake that sometimes technical founders make. And I'm able to say it because I was technical founder and I made this mistake where, you talk to your friends, hey, I have this cool idea, of disappearing images or, something. Disappearing images became big company. But what do you think? And your friends never want to hurt your feelings. They won't tell you that it's a bad idea and stop wasting your time. What they will say is, oh my God, such a great idea. You should totally work on it. It's really cool. Um, how do you solve this problem? When you want to get feedback, reach out to people you don't know who are experts in that space. So cold outreach on LinkedIn, call people, go to networking events, meet random people and ask them for feedback because they won't care about your feelings. Hopefully they'll tell you what is the truth. And once you have enough of these conversations, what you will have is conviction. Then you're not talking to an investor saying, hey, I have this idea. What do you think? You're basically telling them, look, I've actually talked to 30 plus customers. And after those conversations, this is my key insight. And I think this is going to be a big company. And once you have that conviction, that quickly leads to conviction on the other side too, right? If you yourself are not convinced, and imagine like the investors talk to like a lot of founders every day. So they can pick on those small things very, very quickly. It's very hard to hide in those kind of conversations. But once you are convinced that this is a large market, this is potentially a big idea, and what you have is fundamentally differentiated, then you are basically setting yourself up for success. So do that product market fit work before you start building the product. As engineers, we can build whatever we want. We can solve all the hard technical problems. But then you build something like Google Wave, then you launch it and realize nobody wants it. And you don't want to be in that position. So do that work early before you start building the product, would be my general advice as a former founder and technical person. I mean, I still write code, not to the same extent. Then once
Ashish,
you're ready, yeah. Yeah.
so there is a question here. When there is a solo founder, do you help with getting an early team as well?
Yes, definitely. We have helped founders with that. I run a lot of off the record kind of events, which is around founder networking, founder dating. It's a dating process, right? If you start a company, it's going to take you 8, 10 years to be successful. So you want to work with somebody you're very comfortable with, who complements your skill set. So we facilitate those introductions. A lot of purely pre-seed investors help with that. What is important is, what do you want to work on and what's your background skill set? If you can really build something that has a unique technology insight, which is something I've highlighted here. And key technology insight is basically something you can build that if you tell a 10x engineer, this is what we are doing, they cannot figure out how to implement it. Then you have something that will help you build a massive company. To give a specific example, I'll go back to somebody I worked with in the past, but VMware, when the company was founded, there were research papers that said virtualization is not possible. And VMware as a company, the founders basically showed how you can install multiple operating systems on the same hardware using a hypervisor. So all the technology was all those research papers were basically irrelevant, right? They had such unique technology inside that other larger players could not take market share for them. Right now, I mean, look at what's happening with OpenAI. They're kind of out executing Google in consumer LLMs, right? Sora is incredible. So once you have that key technology inside, you can build a big company. So you as a solo founder, if you bring something that's spiky, investors will want to work with you and help you, with the founder matching. So that's definitely a value add.
One quick question, Ashish, for the previous slide. How do we know when we are ready for the VC pitch? Is it after the MVP complete and have a few customers, or after we make some meaningful revenue out of the product? I think
Yeah,
this is
I
an
think
excellent question.
that's a great question. I would say that you're never too late. You're never too early to talk to investors. As a matter of fact, if you are right now, working somewhere, and if you want to start a company, before you quit, start talking to investors and build that relationship. And then when the timing is right, when you have some idea of what you're going to build, they will write your first check. They will help you register the company and get the company off the ground. This is how some amazing companies have been built that I have seen. So if you already have customers, right? I mean, you could do that if that's what you really want to do. But typically, for a small raise like $2 to $4 million, you have a 2 to 3% team. Typical, right? I don't want to generalize anything because every situation, every deal is different. But typically, it's a 2 to 3% team with a deck, with some idea of how you're going to go to market, how will you make money, how will the customers discover the product, and how will you put that money to work. And that is sufficient. And if in Silicon Valley, I think the risk tolerance for investors is very, very high. If you compare it to markets like Boston or Chicago, they'll ask for a lot more data. But here, I think investors are more likely to bet on the vision of the founder. So start early would be my advice. If you talk to them when you're actually raising, maybe it's a little late. Talk to them before you have decided you want to start a company. Start brainstorming so that they feel like they're building it with you. And the best investors want to do that with you. They want to build a company together. That's what I want to do. That's why I love it, because I love building stuff. Now, I don't build it directly, but the ability to work with incredible founders who I can support really motivates me. I mean, that's why I'm doing it on a Saturday morning, right? Just like you are here on a Saturday morning. So that kind of match, I think, would be very, very helpful. So start early would be my advice.
So does that mean even before you have an MVP, you should start with that? No revenue, no daily active users, MVP still being built.
I
Even
would
in
say the
that
answer
stage,
is,
you're recommending to reach to a VC and build a network?
I would say the answer is yes, at least in Silicon Valley. Now, Silicon Valley is different. Keep that in mind. I mean, here the risk tolerance is high and the investors will work with you. And investors, a lot of them have actually built companies in the past. So they will be very, very helpful. Because if you go and raise after MVP is done, then the next question will be, okay, talk to me when you have some customers. Then you will gain 1 or 2 customers. The next question will be, okay, let's have a conversation once you have 10 customers and you prove that you can scale. So maybe in a way you're setting yourself up for less spectacular success in that term. I don't want to go that way, but earlier is better. Before you start something, before you build, work with them for a few months, and then timing is right before you have done anything. Hopefully stars will align. There will be a match on both sides, and magic happens.
Yeah, thanks, Ashish.
Okay, so quickly, you're ready to talk to investors. What should be in a seed deck? I would say just these 10 things. The most important ones are in the top. Team, what makes your team very, very unique? If you have won Nobel Prize in the past, put it in the deck. Don't assume that investors will know that much about you, because as technical founders, we do not talk enough about ourselves and our accomplishments. But if you're meeting somebody for the first time and that meeting could have long-term impact, share that data, because that will be very, very helpful. What core problem you're solving is very critical, because a lot of pitches just never get to this. It's founders building cool technology products, but even they themselves don't know what the core problem you're solving. So that clarity in the deck, it it is not just going to help the investor, it's going to help you, right? Sometimes when we build companies or products, don't have that clarity ourselves. But putting together in a very simple deck, like it's not too much, it's just 10 slides. Don't over-engineer this. Key technology insight will be very important. So like I said, what's so special about the tech you're building? Why will it be successful when larger incumbents come after you as you start scaling up and taking their market share and eating their lunch? Why now? This is a fundamental question, right? Right now, there is this trend around generative AI. All companies are trying to figure out how to integrate those tools in their multiple teams and get value out of it. Um, the next thing is some of these will be hacked, attacked, cyber attacks are coming. So if you want to start a company that's focused on security for AI, is the timing to start a seed company now, or was it last year or a year before? This is an important question, because if you're moving with the market, maybe you're too late, because there is some company somewhere in stealth that has been funded that will be announcing in 6 months, and they will have a year or so kind of advantage over you. Or, you start a company 2 years ago when there were no LLMs, nobody was excited, and you were so early that it was kind of a dead on arrival kind of situation. This why now is out of most of our control, but this is so important to articulate in this deck. And then rest of this would be more around competitive landscape. How will you make money? How much are you raising in the end? So keep it very simple. One thing I suggest to early stage founders is a 10, 20, 30 rule, which is very popular. 10 slides, 20-minute presentation, 30-point font. And the logic is just less text, more visuals, and clarity of thought is very important, so that when you share that deck with an investor, if you're not there and if they're just scrolling through the deck, they still understand the vision of the company and what you're looking to build in the long term. I think we're getting to the end of this, so bear with me for just another 5 minutes, and then I'll stop sharing this screen. Note on valuation for early stage products. It's both an art and science, but at every round, it's okay. It's typically going to be 20% plus dilution in each round, and that's okay. Founders should worry less about dilution. Um, Obviously, as an investor, I would say that, but it's also true. Less about dilution, more about the person you're adding to the board and to the cap table. Like I said, bad money on the cap table, it could be long-term painful experience. Somebody I used to work with said, it's easier to get out of marriage, but it's not easy to get out of a investor-founder relationship. So invest in good people, bring good people with experience who will actually help you on the board. So what I've seen is, there is a tendency where, oh, I have $1 million ARR. Now I want to raise at a $500 million or $1 billion valuation. And it feels good, right? It's in the news. Your family is talking about it. Everybody is saying, great job building a unicorn. But really, the reality is only time valuation matters is at the time of the exit. If you actually sell the company for $1 billion, and if you own 10, 20%, you have basically, have such a meaningful impact on yourself and your family. But if you raise at $1 billion valuation and your metrics are not there, too much too early can cause multiple issues. Indiscipline, because you will start chasing areas that you probably should not invest as an early stage company. The focus is going to be so important. There's a classic saying that companies die of indigestion, but not starvation, because they try to do too many things. And if you have too much capital, you'll try to do too many things, and you won't be staying true to your core mission and vision. So this is just really important. And what I've seen is repeat entrepreneurs, they don't care about valuations as much. They just want to work with great people, build a great company because they know three to be true. The only time it's important is at the time of exit. And final thing is shortlisting the right investor, right? Like we've had all this conversation, but it's such an opaque industry. So as that founder, how do you reach out to these investors? So one thing is, it's a long-term marathon. Be prepared for that. It's not going to be quick. But the positive is you just need one investor to believe in you. You may talk to 70, 100 people, get a lot of rejection, but that's okay. I think you have to be prepared to be disappointed. What's important there is with every conversation is you're learning something new. What kind of questions are they asking? How do you improve your pitch? And as long as you're learning and improving with each pitch presentation, you're setting yourself up for success in the long term. Then tactical advice, prioritize not just the fund, but also the investor at the fund, because funds have investors and they focus on different verticals. Like I spend my time thinking about cloud infra, AI infra, cybersecurity, things that need fundamental technology. I love working with with technical founders. But somebody else who focuses on climate change investing or other verticals may not be as excited or kind of consumer investing. So when you make a list of people to reach out, like maybe start with a 20-30% list, not person fund and person both. And then think about who is blogging and tweeting about the problem you're solving. And that's where you're likely to have a good conversion rate. Warm introductions always. So, if you build a deck and send it cold outreach to investors, just think about problem from their side. They are getting approached by a lot of founders, and it's a hard problem, right? How do you pick the ones that you want to speak with? But you can solve that problem by going through somebody who is a common connection, who is trusted contact. And if you don't have this, work on creating these. Those are important. And once you meet investors and you want to know if this is the right person for you, when you're at the term sheet stage, I think blind founder references are very helpful. We tell all of the founders, hey, anybody we work with, go talk to them, because this is a priority for us. We actually mean it when we say we are founder friendly and we add value. It's not just for marketing buzzword purpose. So talk to the people they worked with in the past. And then finally, I'm available at ashish@thomas.com anytime. Always happy to help and have these conversations. So feel free to reach out. Email, LinkedIn is right here. And I think that's all I had. I'll stop sharing my screen now and open it up to Q&A.
Awesome. Ashish, you have a ton of questions to answer.
All right.
So I start with the one that we put on the parking lot. So I guess the question was, how do you set a valuation for an AI company at the seed round level?
Yeah, so when you think of an AI company, right, the nature of the company is going to be very interesting. Are you building a foundation model, right? We are investors in Cohere. To build a model like that, you need tens of millions of dollars before you will know if the model is working or not. You have to use ton of data, internet scale data. You have to spend a lot on GPUs, and you have to use the training for like months and weeks and months. So just to get started there, the capital requirement is so high. So if a company that's focused on foundation model like Cohere, Mistral, Anthropic, if they raise large capital, it's not because one factor is you just need that kind of money to start a company. Now, on the other spectrum are companies which are using maybe OpenAI APIs under the hood, Cohere under the hood, where it's more an application play, where it's less of unique technology and more of unique market insight. Your capital needs may be not as great. So the way you should think about financing is how much do you need to build the product and have a 18 to 24-month runway, and work backwards from that. Build a model, hey, I need to hire like 5 engineers, 2 designers, and then 2 of our co-founders. That's a good enough team, right? and this is going to be the comp, this is market standard, and then we'll have to spend on GPUs and compute, and then maybe some money allocated for marketing. Use that and build. So the number will essentially come from there. So we hear a lot in the news cycles these days, right? Companies raising tens or hundreds of millions of dollars. Like I'm seeing 70, 80 million seed, which could be a sticker shock to most people, but to build some of these businesses, you just need to raise that kind of capital. I would say that these are exceptions, not the norm. The second part is valuation. Like I said, I think it's both an art and science. For a founder who has done this in the past, the risk is significantly de-risked, because if you're building something in the enterprise, you know how to build a sales engine, you have your relationships within the key buyers at large corporations, you know how to put together a team. A lot of times when these founders start something new, people they have worked with in the past move with them. So it's more about de-risking more than anything else. So that's why you will see, like, maybe they'll get a better, not better, better is a relative term, but somewhat higher kind of valuation than somebody who is starting a company for the first time. And now the question is, building a company in any area versus AI, that's a completely different thing. I mean, there is hype. Last year was crazy. This year, that hype is slowing down a little bit. But what's happening this year is the POCs are actually moving to production. So there will be a lot of revenue in the enterprise space this year. So the hype was there for a reason. This year hype is low, but the real use cases will be there. So I continue to be excited. I think some amazing companies will be built in this space. If you're building something, want to brainstorm, feel free to reach out.
Awesome. Thanks, Ashish. The other question that I have here is how to build a company to be acquired versus go IPO. Should that be discussed with the VCs at the seed or the Series A stage?
That's a very good question. I think as an investor and having worked with a lot of investors, seed is too early to have that conversation. But bigger point is investors want to invest in founders who want to build a great company. Why is that important? If you're already thinking of exit, then you are likely to take an exit at the first opportunity that presents itself to you. So if you could build a $1 billion company or an IPO class company, and somebody makes you an offer of 60 million, 1 year after you start, how do you make that decision? I think that this is just a very simple example, very basic, but thinking long term is very important. Founders who want to build a company for the long term, investors want to work with them. So having this conversation at the seed is a little bit premature when nobody knows what the product will be, what the market will be. Most companies will pivot as they talk to customers. So yeah, I think at seed is too early. So I would encourage you to kind of bring it up only if investor wants to hear your vision, and it's not very helpful is what I would say.
Okay, moving on, Ashish. Another question is, if I am a solo founder but have a working MVP and some initial level of proof of PMF, would it be a good candidate for VCs for seed or pre-seed A round? We see some solo founder companies like Moglix in India being successful. Why do VCs see team at seed and pre-series A level, as I can hire a CTO or a sales head as employees?
Yeah, good question. This is a bigger question around solo founders, right? If I'm understanding the question correctly, solo founders versus the team. Just think about the risk. If you're betting on one person, right, and you own like 100% of the company, when you're raising capital after dilution, you still own 80% of the company, and investor has 20%. So when it is time to make a big decision, right, about the future of the company, and if there is misalignment between the founder and the investor, right, you have an outsized impact on that decision, right? And investors, even at the board level at that time, won't be able to help too much, right? So I think it's a question of risk and reward in the long term, the way investors will think about it. Solo founders build great companies. There are a ton of examples of that. But having somebody with you on that journey, when things are hard, you can brainstorm and share with that person. See, when you're in front of your employees and you are like in a all hands on deck, like 60 people in front of you, as a founder, typically you have to put on your most positive self in front of them so that they continue to be excited. Even when you know the big contract that you were expecting at the end of the quarter is getting slipped or you've lost that to a competitor, who will you discuss that situation with, like investors or your potential co-founders? That it's a very lonely job at the top. So having that person who you can share freely with, who complements your skill set, maybe you have a lot of technical insight, maybe you don't have as much market insight, and you're working together. It's just that I'm not saying solo founders don't build great companies. It happens all the time. Having a team, I think, just de-risk that a little bit.
Got it. Ashish, would you have a little more time for a bunch of other questions?
Yeah, I am here. I have kept some time for this. Happy to continue this if this is helpful.
Awesome. Thank you for spending more time with us. The other questions I have here is, would you be able to share an Excel template covering the P&L of VC funds and how it sets the guardrails for TAM, CAGR in the portfolio companies?
Unfortunately, I can't do that. I think it's a good question, but there are a few things that we just won't be able to share.
Fair enough.
Yeah, I'm thinking if you want a sample template for founders and some of the pitch decks and other things from where we have learned some things, happy to share that so that it helps you build that model. But yeah, I think as an investor, it's hard to share data about the fund.
Right. Fair enough. I am working with my friends as a part-time on an idea, and when we build the MVP and validate the idea with real user, can we approach VCs or do at least one of the founders should be working full-time before reaching out to the VCs? I hope the question is clear.
Where is that? And Vikash, I'm just curious if we can just let people ask if they are. I'm trying to see. So when
That's
you
a good
talk to
point.
investors, is the question that should you be working full time on it versus part time? Yeah, I think part time is fine as long as there's a clear plan that, hey, I'm going to spend 3 months on this, and then the plan is to leave the company and build this full time. But if you're actually raising capital and majority of your people are part-time, the question would be, hey, how committed is the team to this? Are they just like, are you all in or not? You cannot build a great company unless you're all in. You cannot build a successful company evenings and weekends. So you wouldn't want to work part-time if you want to build a great company. I hope that answers the question.
Awesome. If anyone wants to, ask a question, I can unmute you. So if you can please raise your hand if you want to ask the question. And in the meantime, I'm going to just go through the questions in the Q&A. But feel free to raise your hand if you want to chat and ask a question. Okay, I have a few hands, and I'm going to go in the alphabetical order. Aki, I just unmuted you. If you can please talk about your question.
Yeah. Hey, I'm audible, Ashish?
Hey, Aki, I can hear you.
Yeah. Thanks, Ashish. My full name is Akhilesh. So just a short time I have put over there, and it was a very nice session. A quick question is, you have talked about the success path. Can you please tell a failure path? And a very simple example, I will say. So I have a MVP, okay, and I have got a seed funding, okay, and it's going great. But unfortunately, there is no PM fit I am able to see for this product. So what is the best way? Of course, pivot is the good option, definitely. But let me say, what is the win-win for both of us? Because let me say, I want to take a completely off track. At the same time, the seed funders, I do not want to go them high and dry. So a failure cases, or this is an example I have given, or you can yourself share any failure case where the paths have actually not gone the way as it should have been. So I'm more interested for the failures rather than the success. Thanks.
Yeah. So fortunately, the companies that I've invested in are alive and thriving. But I think that's going to change at some point, but I'll do my best to make sure that does not happen. But I have seen some companies, right, where they existed and they raised a large amount of capital, never hit product market fit, and the founders were just not brutally honest with themselves. It is down to that question, like you want to keep building something, it feels good, but there is no market, no customers, then are you doing the right thing? You mentioned pivot, right? Which is an option. Another option, I've seen some founders, just talk to their investors, hey, this is not working out. There is clarity and figure out the next step. And it's hard. I'm not saying like for me to say these things is very easy, and I recognize that, but you have to like make that call sometimes. To give you a very specific example, there's one founder that I know who was running a company for last 6, 7 years, never hit product market fit, but just kept building because the founder had raised enough money and the burn rate per month was low enough that gave them a long runway because the team was very geographically distributed. This founder had sold his previous company, made a lot of money. So, the company was fine. It was, but in the end, I think it became clear a few years ago what's going to happen with this company. Only person it wasn't clear to was the founder. And I think that became clear last week. It's sad and unfortunate, but unfortunately, I don't have more to share on the failure side than that. But that's part of the part of life, and part of this journey. People talk about successes way more than failures, and there's just so many failures, and that's why it's a high risk kind of business. If you want to chat offline, we can continue this conversation. If there's something specific I can help with.
Yeah, thanks. Just a quick question, if it is possible. So, quick question is that will the investor be willing to write off? Okay, or they will request the founder to raise a debt and allow to be. So, what is the possible two ways? Worst scenario, or should the founder raise a debt and give a quit for them, or the investors may be quite happy that okay, you can go ahead and we will write off. Thanks.
Yeah, I mean, it's not easy question for me to answer, but I think in situations like this, oftentimes investors have already written off the company internally. So one of the questions like 5 minutes ago was, can we share our P&L, which I cannot, but all investors are looking at the health of the portfolio. And, in certain cases, they want to be proactive. If something is not working out, they probably have already done that.
Yeah. Thanks, Ashish. Thanks, Vikas. Thank you very much.
Thank you, Akhilesh. I think the next person that wants to talk is Saurabh. Saurabh, I have enabled you to talk.
Hey, Saurabh, you're on mute.
Okay, while Saurabh figures that out, Ashish Bansal, I have unmuted you as well.
Hi, Ashish. Can you hear me? Okay.
Hey, Ashish bhai, how are you? Good to see you.
Good to see you. Thank you, Ashish, for taking the time, and I wouldn't miss the opportunity to listen to you. I had a question related to there are areas where there's new products being built, like the category maybe does not exist, and I think like VMware example that you gave earlier. There
Yep.
are also areas where maybe a founder might feel that they are trying to do something maybe differently, or Some existing products are there, but they're trying to enter in that area because they believe they have some uniqueness or whatever, right? So in some ways it is good because then you're not trying to create a category, which is hard. On the
Mhm.
other hand, it is bad because there is competition.
Yep.
Any advice for people who are in the latter category, who are trying to build something in an area which does exist? It's not a completely green field or a completely new category, and how should they talk to
Yeah.
VCs?
I think very good question. And this happens all the time, by the way. Category creation for a founder is very, very hard, right? Oftentimes it's a big risk for both investors and the founders. But a lot of companies just disrupt what's already there. And that disruption is so important. I can't share specific details, unfortunately, because I wish I could. But I've seen companies recently which are doing exactly that. Because what happens with success is some companies just become complacent, and the innovation cycle kind of stops. The best people just leave, start something else, or they make enough money in secondary sale. They're not motivated to work. A lot of companies that you see right now, which are in that growth stage, haven't hit IPO yet, but are kind of moving towards an IPO, but the IPO window is closed, so it's not clear when that happens. And they've been in this phase for a few years. Naturally, ultimately, it's people behind companies. Companies by themselves, like it's just brick and mortar, but it's people that make company. And when that talent moves, that creates opportunities for new founders to come in and disrupt that. I'll give you one example from my portfolio. So Isovalent was acquired by Cisco a couple months ago, but they entered the space of Kubernetes cloud, Kubernetes security, networking, and observability. And they did it open source way, but they were companies that actually existed at that time. Companies that did IP tables-based routing when you are basically doing IP addressing for your Kubernetes clusters. But what Isovalent did is something fundamentally very different from a technology point of view. They made the kernel programmable using eBPF. Today, you will see a lot of companies under the hood, they're using eBPF to build their security or cloud infrastructure products. But it was created by this team. Once you have something of that nature that competition cannot copy, that scales, because Docker containers also, like maybe 5, 6 years ago, hardly anybody was using them. Now you have millions of containers orchestrated by Kubernetes in production. So the problem scale has changed massively. The same scale change is happening in data infrastructure today because volume, velocity, variety data is exploding. The same scale change is happening in AI adoption in the enterprise from experimental AI machine learning models to now chatbots that are actually in production. As a matter of fact, Klarna just announced that their chatbot is doing the work of 700 employees right now, and customers don't even realize that they're talking to chatbot. It's that good. So when the combination of those two or three things, companies becoming successful and that basically hurting them if they lose the innovation DNA and people. Second, technology disruption. And third, this change in scale of the market that you're tackling. That creates opportunity for a new company. And those are perfect places to disrupt for somebody like you to like once you want to enter that space. Now, if you build something that's not differentiated enough, it's a 2x improvement versus a 10x improvement. That's the question. Are you improving processes by 50%, or is it like a 10x improvement or 100x is a massive company, 10x is a good company, but if it's below that, then the question shifts and it's more like, hey, how will the incumbent react as you start scaling the company, as you start eating their lunch? So just like giving context. I hope that's helpful.
That is definitely helpful. And if I can just add a follow-up because of the Gen AI piece here,
Yep.
there's a lot of discussion on building on top of foundation models and building products on top of foundation models.
Yep.
And there, the challenge that many people face is why can't just OpenAI or Google or Cohere just do it? So there is a company strategy aspect of it, but technically, if you're building on the foundation model with adequate fine tuning, and the instruction tuning, a lot of that can be
Yeah.
accomplished by the foundation model company itself.
Right. Yeah, no, I think great question again. This question, I think founders hate it and investors ask too many times, why can't XYZ do it? And it's also similar to like vitamin versus painkiller question, which is one of the most hated questions, but also one of important ones. To your question about generative AI, I agree that once you have fine-tuned the model on specific data that only you have access to, that is a very differentiated offering. Now, for someone to go in and, simple question, why can't XYZ do it? Of course they can do it. Of course, Google can build, you know, tools like Datadog and others. Of course, like Amazon can own all of cloud infrastructure, but the reality is that's not how the world works. There's always like as a PM, whoever is there is prioritizing, right? Features and capabilities. And maybe their eyes are set on something that aligns with their long-term vision. And that's the opportunity for founders. So this question is legit, especially when it comes to foundation models. But I think the opportunity is also this market is changing so fast, right? Ashish, you and I were talking about it. Last year it was more a bigger model with more parameters. Then it was like, oh no, smaller parameters with specific data. Now it's like, oh, mixture of experts and whatnot. And the consumer versus enterprise is another way to segment this space. So the space is constantly evolving, leading to these kind of opportunities. My belief is, and I'm actively investing in this space, so looking for founders who are building something unique. I think if you have unique data in a particular vertical, right? That could be legal, that could be customer success, that could be sales. Massive disruption is waiting to happen in those categories. If you want to disrupt a customer success use case, you don't need all the data that OpenAI has. You need the data from the top companies, a few years of data, and then you have a bot that's probably as performant or better with less hallucination than some of these big models. And that's your winning kind of company. You disrupt one vertical and then you keep expanding it, and then it becomes a land and expand kind of model for you in the long term. I mean, I believe in that vision. So, but it's up to the founder to communicate that, right? Hope that helps.
Absolutely, thank you. We need to catch up, Ashish, to discuss the new
Yeah.
developments one of these days.
Yeah, let's grab coffee.
Thanks, Ashish Bansal. Then we have one more person who wants to ask a question, DC. Sorry, I just have the short name here.
Oh, this is me. This is Deeksha. Hi, Ashish.
Oh, hi, Diksha.
How are you? Thanks for having
Good.
this webinar. Very informative. So my question is about something you said earlier around seed, that VCs or people are not that excited about investing if you already got customer at the seed level. So we're in the situation where we are at the seed level. We want to raise at the seed level, but then we've also seen, like, when we put maybe one customer in their potential customer, we don't see any questions about that. Or sometimes it's like, oh, people say, oh, why don't you get more customers, and then we talk exactly what you said. So what is your recommendation? Should you talk about your potential customers at the seed level, or should you not?
Um, so again, like I think one of the things I don't want people to take away is that whatever I said is how things work. It's a kind of general observation, but in venture, by definition, there are no rules. You will see crazy amount of financing, crazy valuation. You'll see all sorts of crazy stuff. All that needs to happen is you as a founder need somebody who believes in your vision, and there is a good match there. Now, to your specific question, having customers and having a pipeline of customers, you can project, hey, I'm not just building something because I think this is interesting. I actually have a pipeline of 5 to 10 design partners. Let's say 5, right? And they're actively engaged, they're giving you feedback, and you're building something to solve their problem. that is very important. That also indicates that you're just not coming at it from a technology point of view. You're working backwards from the customer needs. I would say that's a plus. Now, if you
Okay.
say I have one customer and you don't have pipeline to share,
Mhm.
it's hard to figure out is that your target market, or how big is that particular vertical? Like maybe you're building something, to solve problems for the insurance sector. So, but you have customer from oil and gas just because it so happened. Like, is that scalable? Like, you're building for some area and this customer is completely out. How will you gain your second, third customer? The questions are basically coming from that angle. How do you scale once you have your first few customers? How do you have a repeatable sales motion? That will be the bigger question. But having that design partnership is a plus. So I think that should definitely help you in these conversations.
Got it. Thank you so much.
Awesome. Ashish, before I give it to the next person, I want to cover a couple of questions in the chat here. Apologize, just give me 1 minute here. There was a question about geography, and is it equally likely for anyone to raise anywhere in the world, or are some geographies more inclined for the VC fundraising?
Yeah, I think geography is a very important, interesting question as well. At TomWest, our focus is primarily in the Bay Area. And one of the reasons is over time, we have invested in the networks. So we make it available to the founders. When you're in the geography, wherever you're building the company and investor is there, we can activate our network and help the founders. Ultimately, that's where all these decisions are coming from, what kind of value we can add. We have networks on buyer side, investor side, potential co-founders, and these are typically the things you need as you build and scale a company. Now, if I were to write a check for a company founded in, I don't know, France, like I don't have much network there. I have a big network in India and I have a big network here in the Bay Area. So the effectiveness that I can have and the impact I can have as a board member will be limited just by definition. And the second thing is board meetings happen once a quarter. So if you are in France and then I have to fly once a quarter, or if you're in India. So not again, never say never in venture, and there are no rules. So I'll keep going back to that. If it is an exceptional company, I would write the check. Our firm would be very, very interested in working with exceptional founders, irrespective of geography. But generally speaking, like most of our investments are here in Silicon Valley. So I think that helps. Also, the mindset of investors is very different, right, based on geography. Earlier, I alluded to investor landscape in Boston, Chicago. The reason I mentioned those is I was in Boston working for a tech startup. I was in Chicago getting my MBA, and I've seen the ecosystem evolve in Bangalore and Delhi. There is value in close proximity when you raise from investors. If you can meet them for coffee, like what we do is, just to give you a very specific example, we don't if you're meeting with investors only during board meetings, investors are failing and you are failing, right? Investors are not doing their job of governance, which is the most important work they do at the board level. So we are always in touch with our founders, evenings, weekends, whenever they need anything. And board meetings are important, but most of the work happens before board meetings, right? So if you can quickly grab coffee with somebody, that is helpful. So I'm just coming from that perspective. That's why some funds have very strong geography focus, because they know the space. Then they can also source effectively. Like here, I know a lot of founders who have built trust with. So when their friends or their direct reports or their seniors start companies, they're kind enough to make an introduction. I may or may not have that in other geographies. So like it's possible, but having proximity is very helpful both for the founders and investors.
Sure. That's very helpful, Ashish. One other quick question relevant here is, how should the IITG students, alumni, and family in the larger sense reach out to you, and how can you help them? Yeah, that's the broader question here.
Yeah. So my contact information I already shared, ashish@thomas.com. I'm very active on LinkedIn, so just send me a note introducing yourself and something that you need help with. If you're building something that is technology from differentiated from a technology point of view in the areas of cloud infra, cybersecurity, AI, ML, I can help. I can help a lot. I can confidently say that. If you're building something outside of those domains, my effectiveness may not be there, right? So that's one question, how to reach. The second thing is, I think as IITG alumni in the US and other places, the network is growing. It's so powerful. My most recent investment is in an IIT Guwahati founder. I talked to a lot of IIT Guwahati people, and not just IIT Guwahati. I think the IIT network in Bay Area is so strong. There are like 15,000 plus alums who are building something very innovative. And fundamentally, people are very um, motivated and driven. They get bored. They can't do the same job for a very long time. That hustle is this just never leaves you. I guess at some level. So it's an honor to work with such amazing group of people here. So if there's anything I can do, feel free to reach out. I may not be able to help everybody, but what I can do is if I know somebody who can actually help you, I'll facilitate that introduction. But it's my commitment to the IIT community broadly. If you need help, and if I can in these areas that I understand, venture and early stage startups, I'll make time for you.
Awesome. Ashish, that's very encouraging for a lot of founders. So thanks for saying that. Now I'll switch to the speakers. Anirudh, are you in a position to talk? I see your hand raised. Anirudh Rawala.
Hey, Anirudh, you're on mute.
All right. While Anirudh figures out the audio issues on his side, Rahul Sanal, would you like to chat? Are you in a position to ask a question?
Yes, I am.
Hey,
Thanks,
Rahul.
Vikash. Hi, Ashish. So this is a little personal question. So you had a lot of learning from IITG, then you you graduated as an engineer, then sales engineer, then founder, and then VC partner. So there is a huge learning curve, something that a university cannot provide, something that you can only learn by doing stuff, breaking stuff, and so on. If there is something that you would like to advise founders on how they should keep their learning path going, uh, right from college time itself, what can we do a little differently? And how do we keep our learning happening all the time so that we reach at a founder stage a little earlier in our life? Specifically with regards to Gen AI having a big disruption right now, 10 to 15 years down the line, it's going to be a new world. What disruption do you see in the education space as such?
Okay. Tell me more about you. Are you on campus right now, or are you building something?
No, I work as a product manager in an IT services company in India.
Okay.
So not in campus, but
Yeah.
I always wanted to do something interesting, but within the college curriculum and the exposure, it's very, very limited. But then you get into jobs, try out stuff. It's a different ballgame.
Yeah. So my observation is the best careers are not linear. Here in Silicon Valley, the people who rise to the so-called top, they take multiple routes, they take multiple risks at different points in their life, which is very important. Just going back to my experiences and observations, before I moved to venture, like in Boston, I was a PM, but in evenings and weekends, I was going to a lot of these meetups, networking events, wanted to connect with more interesting people. And one of my goals this year is I do a lot of journaling and end of the year is to surround myself and hang out with people way smarter than myself. And there are a lot of those. So I have that realization. Long time ago, I wanted to be a founder. I don't want to do that now. come to accept the fact that I may not be the best founder, but I could be the best person who supports a founder in their vision. And this goes back to my time at IIT Guwahati. I was in the final year, I was a general secretary. I ran the counseling cell. So I was talking to a lot of people who were suicidal in nature at some point. Unfortunately, that's just how it's so stressful. And it has helped me, with empathy and building relationships and separating what is true from what is hyped in a sense. Now I'm diving a little bit more on the philosophy side. A few weeks ago, somebody I knew and respect, he passed away of cancer. Similar thing happened with one of our colleagues. So, the time is short, life is short. So what time you have, we have to make most of it. I believe that it's not just a funda. I actually do live my life like that. So whatever you're doing today, if you want to be a founder, why are you waiting, right? You will never gain skills. You can be a product manager, you can take classes at Kellogg. I went to IIM Calcutta too. Nothing that is taught in schools will prepare you to be a founder. You have to take that plunge when you're ready, figure out what is it that you really want to do. Are you excited and passionate? And don't do it because you want to impress your friends and family. Do it because you want to do. And that's the only thing you can think about. When you are in that phase,
Right.
you will be very committed. Right now you mentioned generative AI, just so much happening. Like in India also, I think if you look at IIT Madras campus, they are building new models. Their alumni are building and leading great companies like Snowflake. The new CEO is IIT Madras alum. The CEO of Perplexity, I think, is IIT Madras too, or Delhi.
Yes.
The
Maybe
CEO of
Madras.
Glean, CEO of Glean is IIT Delhi. Now, people are just doing amazing things from this network. And just, I think I just want to see more of IT Guwahati folks doing that too. And I'm excited to share that the most recent company that I have, I think they're going to do really, really well, and it's IT Guwahati founder. So hope you start something and give us that opportunity, but wishing you the best as you make that decision. One thing that could help is build applications when you have some time, play with these AI models, because the opportunity is nobody knows how to really use them in production. Like there is a lot of talk about it, but truth is it's all experimental in nature. So if you could be that person who adds some sanity to all this chaos, maybe you can start writing a blog or tweet about it. Do it now. Why wait? I mean, this is the window of opportunity right now till like end of this year. Maybe after that, most of the great companies will be founded in this space. Like, and then there will be others too. But every 10 years, there's one or two exceptional companies that are founded, and others are smaller, but they're still good. So if you really want to do something, I would encourage you to, start early, start now, and not wait too long.
Thank you so much, Ashish. I mean, it was nice conversing with you, and I've taken all of it in the right spirit. Thank you.
Great, good luck.
I see that you have unmuted me, but you got muted in the process. Gosh.
Yeah, I think Vikash is muted. Hey, Tejas.
Yeah. Yeah.
Go
Well,
ahead.
okay. So my question is, you mentioned a couple of few areas that you are interested in, in investing. But when someone starts a company that may not be in one of these areas, but eventually it might so happen that one of these areas could be relevant growth avenue for the company. But how would you know that upfront, and how would you take the bet to, maybe invest in a company which is not directly in
Yeah.
these?
Yep. So let me share my screen. This is why I had one slides in the backup portion of it. So we are thesis-driven investors. What we do is we'll dive into a particular area, spend 3 to 6 months, learn as much as possible about that area, hope to become an expert, even though it's not really possible, but learn as much, talk to a lot of companies and form opinion. And that thesis could be, this area is ready for investment, at least for us, or it's a pass for us. In that case, both are good outcomes because we have made a very thoughtful decision about a particular area. So most of my investments have come out of that. Like we get excited about a space, then we talk to founders who are building something amazing in that space, and if we get convinced, then we'll try to win the founder and the company. So here is what's happening. So if you look at quickly, just 1 or 2 minutes on this cloud stack, right? There is hardware vendors, there are infrastructure as a service vendors. On top of it, there is security and ops vendors, and finally web and mobile applications. This entire cloud stack took like 15, 20 years for adoption. From the time this AWS was created and made available to public, that was like 2006. I was building AWS hosted applications in 2009, 2008 and 9, which was very hard. There was no data available at that time. If you switch to generative AI, basically all of that is happening in a matter of weeks and months instead of 10 years. So we started early, and fundamentally what happens is, I think every 10 to 15 years, the way we interact with machines changes fundamentally. It was a long time ago, it was graphical user interface. That was a big thing. Then the browser became a big thing. Then mobile became a big thing. And right now we're in that fundamental kind of shift, which is through these LLM-powered chatbot interfaces and intelligence that's built into these applications. So all of this stack is changing and emerging every day. Like the problem is, what's super exciting in 1 month goes completely out of hype cycle in 3 months in generative AI. That's because things are changing way too fast. This is such a broad and massive disruption. Nobody knows how to react to it. I think everyone is trying to figure it out. But what's true is you will need hardware to train these models, to fine tune them, to serve inference. You will need a lot of hardware. You will need models. On top of it, at some point, you will need security, you will need operations, you will need orchestration to push these into production, get value out of them, then monitor for performance degradation over time, and then there will be intelligence applications on top of it. This itself will keep changing. So as an investor, I have to have opinions, strong opinions, loosely held is how I would describe, because I know that this will change. I know for a fact that this will look completely different end of this year. So for you as a founder, if you can figure out how this view gets disrupted or what's missing here and paint that picture for investors, that already sets you apart. And, investors want to take the bet on what's going to be the next big thing and return the fund. So if you can convince them and figure out if it aligns with their broader thesis, that's a win. And I hope that's helpful. Long answer, but hope it's helpful.
No, definitely very helpful. Thank you.
I think those are some of the people who wanted to ask questions, Ashish. I just want to open it up for the last question. If anyone wants to ask or raise your hand. I think I have one here, probably.
And I want to say, like, this is a longer conversation. If I can be of help, feel free to reach out anytime, even after this. This is just the beginning of a long-term relationship. And in venture, I think everything is long-term.
All right. I think we'll take one last question. Tejas, are you in a position to ask?
I just asked my question. Sorry, I'll lower my hand.
Tarang.
Tarang.
Hey,
Thank you.
Ashish, Tarang here.
Oh, hey, Tarang, how are you?
Yeah, good. Yeah, enjoying, the conversation. And I feel like, we can do a webinar once where we can just go back and forth. There are so many things I can keep asking. So, but I think one thing from a technical founder, the theme of this webinar, like people struggle to see is how much technical information should be put in the slides, right? Because when you go to VCs, you don't want to waste time and, you don't know how much technical, like due diligence they would do in your pitch deck. So I typically advise, like technical slides don't matter too much, right? It is something you can put as a concept, and ideally you want to protect your IP as well. So, that is something that I feel, but I just wanted to hear your view, how much of technical slide, people should spend time on. Because what I see is like when people come to me, ask like, hey, is my pitch deck better? They spend a lot of time on the tech. And one thing which they completely miss is the business model or, the
Yeah.
competitive landscape, etc.
Yeah.
So what are your views on that?
Maybe a broader question also here was like, how do we, as people, when they start pitching, like, how do they make sure they don't spend 9 months, trying to fundraise and kind of cut short to a few months? Because that's
Yeah.
where like time is of the essence. Like people waste a lot of time in this process.
Yeah. No, I think both are great questions, especially as a technical founder. If you talk only about technology, then that may create a risk like, oh, this person is very, very technical, but is not talking about customer or product market fit. Now, it really depends on the kind of investor you're speaking with. Some investors are very financially driven. Their background may not be in technology as much, so they may not dive to that level in technology, on technology. But what they will do is they'll introduce you to somebody who understands technology at a fundamental level, just to do diligence on technology. Hey, does this make sense, or are we smoking something here, right? But the investors who have built products themselves, who are technical in nature, like getting to that level of insight. They want to see that. Now, the question for the founder is, hey, do I include the core technology in the deck itself? Or I think the question is, or should I bring it up if they ask for it?
Yeah.
I think if they're asking for it, that's a very positive signal. That means they're interested, they're curious, and they want to understand and de-risk the technology side of it. So, and then keep talking about other things. What has happened, and recently in one instance, is the founder, we just never got to that level because maybe there was some nervousness. Hey, I have to protect my IP. Now, think about it from the investor point of view, right? I mean, for any investor, this is an unethical behavior if they look at your data and do something with that, right? If it is core insight and fundamental technology differentiation. But the positive side is they can do it only once. The word spreads very fast in the valley. The founder references are so important. Any investor would not want to kind of mess with their reputation, right? Otherwise, that's how VC careers and funds end. So I think founders should take comfort in that majority of investors would not do it. There could be some that engage in unethical behavior, but that's not the majority of the community. That's something to keep in mind. And especially if they're asking for that data, it's important for them to make that decision. So by not sharing, some founders may just be like, saying no to opportunity, right? It happened in one case with me recently, which is okay. I mean, this is how some things work. Now, the second part of it is more around the fundraising cycle. I mean, it takes time, right? There's
Yeah.
no question about it. But somebody from IDG I met recently was like, hey, should I keep the VCs warm by sending them updates and regular things, which is important. But also, like, one thing to understand is if the VCs are interested, they would want to stay close in touch with you as well. They'll reach out to you for data, for relationship building. They would want to meet you for coffee and lunch and dinner meetings, because they are constantly evaluating, like, when are we ready? Can we preempt this round? And that relationship, once it's built and you are in a phase where there's sufficient proof that the company is going to scale with more capital, somebody has to get convinced that, okay, I'm going to just do it now. If not, you're basically entering this formal fundraising process. If you start that process with somebody completely new, I would say the likelihood may be a little less that you'll gain kind of, you'll convert that investor. But if you actually spend time building that trust and relationship, then you can say, hey, now is the time to make a decision, yes or no. And you have a few of these warm relationships in the pipeline. Then once one of them is convinced, they will also bring their network and then maybe fill the round. Maybe like you're raising a $50-60 million round or $100 million round. Somebody gets convinced and writes a $20-25 million check. They will activate their network because everybody wants to be a part of amazing company. And then the round fills up pretty quickly. But that's why I think my advice to people in general is invest in those relationships. I know founders have companies to build and a lot of different priorities, but I think this is also important. And maybe somebody on the founding team keep doing that and figure out who is going to be your ideal investor and spend time building that relationship. Because at the time of financing, the way we work is we spend all this time building the trust and relationship, and at the time of financing, it's just a question of how much are you raising and what's the valuation? Do we feel comfortable? But
Mhm.
all the work has happened by that time. But if
Mhm.
that work starts when you start fundraising, for some investors, it might be too late.
Yep. I know.
Yeah.
Yeah. Mhm. Thank you.
Thanks for joining, Tarang. For those who don't
Yeah.
know Tarang, he's a IIT Guwahati alum and building something very, very exciting.
Yeah. Thanks, Ashish. I would also just like, like scratch your back. I feel like, I met Ashish once and like he's like super helpful and warm. I like, just been like friends since that one first meeting coffee. So,
Yeah.
he's very special in my mind. Mhm.
Thanks, Tarang. Appreciate it.
Yeah.
Awesome. Thanks for all those questions. I think that's the last question for today. Thank you to everyone who joined us today. And special thanks to Ashish Kakran for sharing his valuable insights and experience with us. I know there are a bunch of unanswered questions for which I request you all to connect with Ashish offline. His contact information has been shared. You can find it on the event information. His LinkedIn is shared. Remember, this webinar has been recorded and will soon be available on Spotify and YouTube for those who want to revisit the discussion or share it with other friends who could not attend today. If you are interested in moderating this session in the future or have interesting speaker recommendations, please don't hesitate to reach out to me and to express your interest in moderation or to also recommend a future speaker that is of interest and from which we all can learn. And lastly, your participation and questions today have been greatly appreciated. With that marks the end of today's session. Thank you all.
Yeah, thanks so much everyone for joining. Really appreciate you taking the time on a Saturday morning. Like I said, it's the beginning of a discussion, so reach out if I can help with anything, and especially in cloud security and AI, I'll be very happy to help. Take care. Talk to you soon. Bye.
Thanks, Ashish. Thanks, everyone. Bye.